This dial shows how Americans feel about their money right now. 79% are optimistic about their financial future. But look what happens when the data flips to reality. Half the country lives paycheck to paycheck. For Gen Z, financial satisfaction drops to 41%. To ease that squeeze, Washington policymakers and Silicon Valley developers are rolling out a series of new tools. They're promoting policies to fix housing, combat inflation, and even rethink how you budget on your phone. And Washington is making moves, some that could help you, and some that could quietly drain your savings for years. Grabbing hold of these solutions without understanding the catch is a fast track to draining your long-term personal wealth. Take the housing market. Mortgage rates are sticky, hovering near 6%, which means high borrowing costs will likely keep many would-be buyers on the sidelines well into 2026. The proposed solution from the current administration involves directing $200 billion toward mortgage-backed securities to drive rates down. They also want to let buyers pull from their 401k retirement accounts without the usual early withdrawal penalties to cover down payments. This chart shows the long-term math. A starter home down payment could cost $60,000 today. Taking that amount out of the market now amputates this massive curve of compound interest, trading hundreds of thousands in future retirement funds for a present-day asset. Then we have the Federal Reserve, the institution that controls the cost of every dollar you borrow. Despite heavy political pressure to lower rates faster, the Fed is holding steady with a highly cautious approach. This graph illustrates exactly how that impacts you. Because the prime rate sits 3 percentage points above the federal funds rate, any variable debt you hold, like credit cards or home equity lines, remains locked at these highly elevated levels. If you have variable rate debt, credit cards, home equity lines, pay it down aggressively. Don't wait for Washington to save you. The pressure is also hitting the healthcare sector. Projections show Affordable Care Act enrollment could fall by 5 million people this year, driven by shortened sign-up windows and stricter documentation rules. Without congressional action, the enhanced premium tax credits that have kept plans affordable are set to expire. Millions of middle-income earners are about to absorb drastic out-of-pocket premium hikes. We are already seeing the human cost of this math. 1/3 of U.S. adults are cutting back on essential food, utilities, and gas just to keep their health coverage active. Naturally, the tech industry sees a market in this anxiety. Silicon Valley is stepping in to offer relief, recently launching tools inside ChatGPT that analyze your budget and spending habits in seconds. Through integrations like Plaid, these AI tools can link directly to over 12,000 major financial institutions, pulling raw data straight from your personal checking accounts and brokerages. But there is a massive security trade-off. Last year alone, Americans lost nearly $21 billion to fraud. Handing your bank login directly to an AI model introduces serious privacy vulnerabilities and breach risks that regulators are still struggling to map. Outsourcing your financial health always carries a cost. Whether you're relying on government subsidies or Silicon Valley algorithms, the payment is extracted in either cash or privacy. If there is one defining economic theme of the coming years, it is this. Institutions are systematically transferring the burden of economic risk away from themselves and squarely onto the individual. That high level of financial optimism we saw earlier is dangerous if it isn't backed up by a defensive strategy. Hoping an algorithm or a piece of legislation will rescue your budget is a losing bet. To protect yourself, you need an action plan. First, aggressively pay down your variable rate debt. Washington and the Fed are not going to make your credit card balance cheaper anytime soon. Second, audit your healthcare coverage. Verify your subsidy eligibility right now, before enrollment windows close, and you get hit with a surprise premium spike. Finally, read the fine print before connecting your savings to any AI tool. You must know exactly what data is being stored and who is held liable if that data is breached. The rules of the American economy are changing at rapid speed. To navigate them, you have to look past the promises of easy lifelines and know exactly what you are trading away.